All right, folks, we are now recording this this beautiful little webinar we're going to be doing, and so we're going to go through the details of what we're trying to accomplish with the VA loan. So you're going to get to see the VA loan. I'm assuming everybody can see the slides. Please chime in if you're not able to, and we'll go ahead and get going on this. So the whole point of this is the Veterans Administration loans are phenomenal loans. They are specifically designed for veterans. And the beauty of these things is they are truly a significant benefit to veterans. There is a lot going on in this market right now with the VA loan. There's a lot of people who don't necessarily, as sellers, want to accept that. And this information that I'm going to share with you today is really designed to help you see that by them not necessarily being willing to, they're actually doing a disservice to our veterans, because these loans are phenomenal benefits to them, but also it's not a bad benefit for the seller themselves. It's a really good loan to go with. So today, as we go through this, we're going to start looking at general information as far as related to the VA loans themselves. We're going to talk about eligibility and how you can reuse this. In fact, I was just on the phone with a veteran as I was coming in, and he was talking about, well, this is a one and done, so I only want to do it with the right house. I'm like, no, we'll talk about that, reuse and eligibility and how that works, how jumbos work with VA, the different loan types, what is a funding fee and what does that mean to you guys, how the automated underwriting works for VA loans, what are some of the qualifying ratios, some basic information that is kind of hidden behind the cracks, some significant credit events and how they're looked at by the VA, as well as appraisals, and then wrap this up. Now we're going to try to get all of this done in about 50 minutes. Now that's a tall task. So strap in. If you do have a question, you can go ahead and unmute yourself, but otherwise we're just going to kind of float ahead as fast as possible with this information. So the VA program itself actually came into being after World War II. It was a way to help all the GIs who came back from World War II not only assimilate into civilian life, but also to help them to get their own houses. Most of these people had come back. Some of them were disabled veterans. Some of them were unable to work. Some of these were getting military pensions. Some of them were back with whatever. So they instituted this program as a true benefit to the GI at that point in time to help them establish home ownership. It seems to be about 10% of the population in the United States is either in active or retired military capacity. And so that's a pretty interesting thing. And with where we're at down here with One Dream, what you're going to find is that that's a pretty big part of your business, because you're so close to Fort Lee. You've got the other one out there in Blackstone. I don't remember. Fort Pickett and Blackstone. So you're going to have a fair amount of veterans going back and forth here. But there are certain areas that have even higher concentrations than what we have here, like out in Norfolk. Also in DC area, there's a big one up there, some parts of Maryland. So there's a lot of veterans out there, and it's always worth asking the question if they are veterans, because when you go through this, they have a significant benefit that they should be able to take advantage of if they'd like to do this. Now, some of the general information as we get started on these loans. VA loans are not extremely tricky. There are a couple pieces in there that are very important for you to know about, but for the most part, they're going to be considered what is called a full documentation loan. What a full documentation loan means to you is that we have to prove that this veteran is capable of buying this home, and we have to prove it as if we had to go before a judge. And so it's called the ability to repay. And that's what a full documentation means. It means we have to prove they have the income, that they have the pay stubs, whatever income it is, whether it's a military retirement, whether it's active income, whether it's other types of income, to be able to support the payment. There is no down payment with this as long as they maintain full eligibility. And now that's a big deal, because a lot of these veterans that they're coming back, especially their first time home buyers, many of them have the opportunity to be able to fund or to make the payments, but many of them haven't saved up a ton of money to be able to go into the next house. You know, the military provides a great benefit, but they don't always give you a ton of cash. And so that's ways for them to kind of set the playing ground even for them in that regard. Now, these loans are designed for primary residences only. I've had people come and talk to me about the VA loan and say, well, I want to buy one down at the beach. I want to use my VA loan. Well, if you're not planning on living at the beach full time, the VA loan is not the right mechanism for that, because the VA is, they don't do second homes and they don't do anything but primary, no investment. So that's something big. Now, the next thing that you see there is that VA loans are assumable. Now, while that is not necessarily a bad thing for the veteran, just understand that if that loan is assumed, so what assumable means is, let's say they buy the home and then all of a sudden, boom, they're into active duty and they have to deploy to whatever corner of the world that they're going to. When they get that deployment, it's like, oh my goodness, what am I going to do with this house now? Well, I'll sell it to my cousin who lives nearby, but I don't have time to sell it. I'm just going to let them assume it. So what that means is they're just taking over the payments right where the veteran left off. Now, the downside to that is, in this assumption, while that's cool for the veteran, it's not very cool for the veteran, because they tie up all of their eligibility in that property with the person who's taking over the payments. And they don't get that eligibility back until this person either sells the home or refinances the home. And so that's kind of a big trick. You got to make sure that you're talking to them about this, because while it may feel good for them to just let them take over the loan and roll, it's not necessarily to their best interest or their best benefit to do this. And so what I usually tell veterans about this is that, hey, this is a great way to get rid of the house if you need to, but at the same point in time, don't just need to because you're leaving. You may consider finding a rental place to take over for you, rental management company, something like that, instead of tying up your entire VA so that you can't use it again. Now, there is secondary entitlement. We'll talk about that a little bit later, but in essence, that's how the assumptions work. There is no minimum credit score requirement by the VA. However, what you need to know with that is that the VA only guarantees the loans. They don't fund the loans. The funding of the loans happens through the bank or the entity that is going to be handling their mortgage. We call them investors. These investors are the ones that set the rules as far as what credit scores they're willing to let go through. Now, the VA this is a true benefit. I've actually helped veterans in the past that had 0 credit scores. Now, today, that's not going to happen. Okay.
Those were the good old days.
And yeah, but it's not going to happen today. And so the part of the reason why is that during COVID, they pulled out of a lot of stuff, and that's just a big deal. And so you just need to be aware that just because they may have no credit or difficult credit, while the VA may accept it, the investor may not be willing to take the risk.
Can you shop different investors?
We can, but most of them tend to have a fairly similar idea of what they're looking for. Okay, like in today's market right now, it's a 620. That's just where it's at. Now, pre-COVID, 580 was not impossible. It was something that was something that we could do fairly easily. Now, here's what you need to know is once you get below that 600 mark, it's not that we can't do it. It's just that now you have to have some compensating factors. And these compensating factors many times can be easy to have if they've been responsible, but many times if you're below 600, it's because you're not responsible. Okay, so some of these compensating factors would be proof of savings, the ability to save. So you've got a bank account with X amount of money in it, and we can show that you've been a very good person putting away your little nuts all the time and making sure that happens. That works completely great. That's a great compensating factor. Length of time at a job is another compensating factor. Retirement funds, other compensating factors. But keep in mind that all that stuff plays into it. While the VA may still guarantee the loan with the funding fee, at the same point in time, it's not necessarily something that you're going to be able to get every investor to go into. The thing is also to consider is the maximum loan amounts. Now, this slide here is actually a little old. And so what you need to know about this is the VA actually removed their loan caps recently. They actually will go up to whatever you can get an approval in with Fannie Mae or Freddie Mac. So as long as you can get an approval with it, they've removed the income caps for these loans. Which what that means to you is that if they found a house at 600,000, even though that's over top of the conforming limits for this area, the VA will fund it. Now, once you get to a certain point in price, they may require that you put some money in on the deal. And so that money may be a 5%, it may be a 3%, it may be whatever, but the guarantee that they're giving will go up to a certain price range. And after that, then you have to start putting money down. But theoretically speaking, they have removed the caps as far as how far they would go up in purchase price. Now, every area is a little bit different, but that's for the most part, the income caps, not the income caps, but the purchase price caps are different in DC because up there, once again, you can't even find a house with indoor plumbing at 500,000. And so that's kind of what you're looking at. Now, one thing that the VA does allow, and I actually just helped a client do this, that is a VA, is he bought a duplex. He bought a duplex with his VA loan. And his plan was to live in one of the units and have the other unit help pay for the overall between the two. And that totally works. You can do that up to 4 units. And so with 4 units, if you want to buy a quad or a triplex or other things like that, they will fund up to that. They also do manufactured homes, but I'm going to tell you that manufactured homes is never really a good idea if you can help. Okay, just because of what it takes to get in and out of it. Condos are not as easy. Condos, what you need to know with condos, and everybody watch what happened in Miami recently with condos. Okay, so what happens to the person who lived on the other side that didn't have theirs demolished, didn't cave in? Are they affected with everybody else? Yeah, they're affected with everybody else. So if there's 100 units in that place, all 100 units are now declared a disaster, and they're gonna have to tear down that whole building. Yeah, and so now these people are in really rough shape because they just lost their entire home. Okay, that's why the condos, that's why the VA and the FHA are very, very, very picky when it comes to condos. And you have to be, they have a very specific condo list that you have to check to make sure that you're approved on that list. And if they're not on that list, you're not buying it with a VA. You have to go with a different loan type. Now, we don't run into a ton of condos down over here, but that is something worth noting, especially if you start going into the city, like Rockets Landing is one of the big places. We see a lot of those and other areas like that. Okay. Otherwise, it's a great program for pretty much any unit, any home up to 4 units. Eligibility is extended to active or retired military. And they have a specific timeline of what they consider active or retired military. And those who have served 180 days during peacetime or 90 days during wartime. The reserves, now with reserves and National Guards, it's slightly different. So if you have somebody who is just doing reserves or National Guard, that timeline is expanded. You can see there that they have to go 6 full years as a reserve or National Guard in order for them to be able to qualify for the VA loan. It's a very different scenario than what you'll find with them, okay, with an active duty. Now, those spouses who have served in the line of duty or died in the line of duty, they also can carry the eligibility from their spouse who passed away in the line of duty. And so that's a tremendous benefit to them. Now, there's a very specific document we do have to get if that is what they're trying to do, just to be able to get them to make this work. Other than that, it's surviving spouses who remarried or after the age of 57. Okay. Public services, those people can also get in there. public services, health officers, NOAA, midshipmen, Naval Academy, stuff like that. Those people can also get in there. But there is a very specific, document. Each branch, if you're in regular Army, Navy, Air Force, Marines, you get a certificate of eligibility that we have to use. There's a different certificate that you get if you're in one of those other branches. Okay, it's not the same thing. Now, with the VA, what they're doing is in essence, is they are guaranteeing what would typically be the down payment. And so as you can see right there in that bottom line, it says VA fact, VA provides a guarantee of 25% of the mortgage amount against default. So in essence, what they're doing is they're protecting the bank in case the veteran should default for up to 25% of this purchase price. Now, it doesn't come free because they'll reimburse them for it, but in essence, the eligibility that comes in through the VA is something that the veteran pays for through what is called a funding fee. Now, we'll talk about that in a few minutes. Reusing the eligibility. So this is a piece that I was talking to this one person about this morning about reusing the eligibility. You can fully reuse the eligibility if you decide that you want to do this, okay? Now, here's the way it works, is you own a home in Richmond and you want to move out to the country. So you have a VA loan on the one there and you want to use a VA loan again out here. That's fantastic. You can do that, but you can't use the VA loan until you restore the eligibility. So you can sell the one that you have and then you can move into the new one, and you certainly can do that. Now, let's say you're living in Richmond and you don't want to sell that house and you get orders to move to Orlando. And now in Orlando, you want to buy another house, okay, with the VA loan. That is a possibility. It is a possibility, but they're no longer guaranteeing 25% of whatever it is. Okay, so what that means is that now you may have to put some money into the transaction in order to be able to get the VA to work. Many times, as long as the home, let's say they bought a $300,000 home here in Richmond, and then they want to buy a $300,000 home down in Florida, many times it still works at 100% financing. But there are some occasions where I've had somebody who bought a home in Hawaii, which you can't buy. I mean, it's really bad in Hawaii, like Northern Virginia. You can't buy a home for under $700,000 in Hawaii. When you buy that home there, $700,000, you're probably tying up all of your VA eligibility. And so you wouldn't be able to use the VA if all of that eligibility is gone. Okay, so just keep that in mind as you're reusing it. Once you pay off the original loan or refinance it through refinance or sale, then you can certainly do that. Now, if you do the assumption, you can do a substitution of eligibility, but here's what that means is if you're letting a non-veteran take over your home, you're just letting them keep your eligibility. But if you let a non-veteran assume it, they can transfer the eligibility from the one veteran to the other one, so that the person who is letting somebody else assume their loan can move on very easily to the next one and restore their eligibility. Okay.
Do you have to get deployed or any of that to be able to use the?
Do you have to get what, I'm sorry?
Deployed, you mentioned that earlier, that if you get deployed, you can have
Use
somebody
that
else
assumption.
assume the loan. I'm saying, is that a condition for the assumption?
Or can you do it for any
Or could
reason?
you just say, hey, Stacey, you can assume my loan, I'm gonna
Yeah.
move down to Florida?
Yeah, you can have anybody assume it.
Okay,
Anybody can assume it, but here's the thing. If I'm the veteran and I let a non-veteran assume the loan, then my eligibility is gone
Yeah.
until he either sells or refinances. Okay. Yes, we know the eligibility that we talked about there. And then there's the math down below on how they kind of figure the eligibility and the partial eligibility. And it truly is it's a complicated math algorithm, the way they do it. They've simplified it here, but in essence, that's kind of the math algorithm of what they're going to be looking at. Okay. All right, moving into jumbos. They have offered jumbos, but once again, once you get to a certain point in the price, you're now putting money into the game. Now, that doesn't necessarily mean it's a bad thing. And here's what I mean by that, is I have veterans who are per the VA 100% disabled that are still working and still able to do things, but they got a medical retirement from the VA themselves. Now, they get their own pension, they get other things like that. there is no funding fee for that veteran. Okay, for their service and how much they sacrifice to the country, there is no funding fee. Well, that's a savings of 3.6%. That's a big number, really big number.
And that's if they're 100% disabled.
If they're 100% disabled. And so that means that many times, even that, there's no down payment with it. But if you're using the VA loan, let's put it into perspective. I just locked somebody in with a VA loan at 2.5%. Conventional right now is 2.875. Conventional would have had mortgage insurance. VA has no mortgage insurance. So in their case, it is a sweet ride to be able to do it with a VA loan. And this is why some of these veterans, when they're going out and doing this, they're trying to use it in this market. It's really tight, but I think it's tight because the seller and the seller's agent don't know how big of a benefit this is to the veteran. They get caught up on some of the idiosyncrasies of it, which we'll talk about in a second. And we're going to talk also about how to overcome that with sellers. Okay. So there's that. So how do you prove eligibility? With the right here, these are the different forms that we have to use: the DD 214, the NGB 2223, and the statement of service for active. This is what we use for each one of the different types. And really, in essence, we can go to the e-benefits from the veterans page and download it, or the veteran can do it themselves as well. Any one of those ways works. We have access to it. They have access to it as well. So the VA loan types, they go in 5-year increments starting at a 10-year loan. You can do temporary buy downs. The most common one we use for the VA is a 30-year, but I have seen a fair amount of 20 and 25s lately as well. You can do temporary buy downs, but we have to be able to prove it. And you have to, when they qualify, we can't qualify with a temporary buy down. We have to qualify at the fully amortized rate. And so that doesn't necessarily help them, okay, at time. They do allow some energy efficiency stuff to be done. There is ARMs or adjustable rate mortgages we can do as well. The energy efficiency programs are good, but I'm going to tell you, those are really hard to work with because we have to prove that this is going to improve their energy bill by X amount. And no contractor is willing to certify that they're going to improve 15% efficiency on the home by replacing the windows. Okay, and I'm just giving a regular kind of example. I'm not saying that's exactly what they want, but they want something to prove an exact efficiency. So it's really hard to prove that. There are certain things that are easier to prove than others. Okay. There is also a great refinance for veterans that is out there. It's called IRRL. We call it IRRL, IRRRL, but it's an interest rate reduction refinance loan is what it is. And it's, in essence, it's a no doc loan. If you're a veteran, you qualify. That's really what it is. If you're a veteran, you qualify. And right now that IRRL loan is like really, really cool when it comes to rates. They're like 2.3, 2.5, somewhere in that ballpark. So it's a really good place to be. When you're doing an interest rate reduction loan, the funding fee is reduced from the higher amount to a much lower amount, which is 0.5%. Now that number is, that's a pretty significant number because even on the IRRL, even on every purchase, it's a 3.6% unless it's your first use, and then it's a 2.15. Okay, and so that's a pretty big number that gets added to your loan unless you want to pay for it out of cash. And then you can also do conventional refinances and cash out refinances with the VA as well, which is actually pretty amazing. And they'll go up to 100% value on a cash out refinance, which is pretty amazing, just to let you know. I did one recently for a gentleman and that needed to get some cash out, and it was a tremendous way for him to get what he was looking for. This is the schedule here of the funding fees so that you can kind of look it over. So regular military, National Guard, other things like that. You can see the first time use is 2.15. Subsequent use, it actually changed last year to 3.6. So this table is a little bit off. But these are all, this is pretty much the way it falls in line when it comes to that. But they don't, the nice thing about the VA is even though you're paying for this upfront mortgage funding fee, there is no mortgage insurance on the loan. So that fee is totally wiped away You're just paying through a VA funding fee, which in essence gets added to the loan itself. Automated underwriting system, we've talked about this with every loan type so far, FHA, VA, conventional, everybody has an automated underwriting system, and it's essential that you know that we have to use it. We have to get an approval, no different than with a conventional or FHA loan. And when we get these, the same 3 questions apply when you're doing this for buyers or sellers that you're representing, when you're asking the questions to the loan officer to see what you really have or don't have. Okay, so you're asking the questions, have you run the AUS and what were the results? Number 2, is the borrower have any conditions that they're not able to satisfy? And number 3, are there any overlays that your company requires that the borrower may have a hard time satisfying? Those are the 3 questions you have to ask as you're going through this. And I'm going to tell you that that's pretty important. Now with us, we don't have any overlays, and you can see that right there. There's automated system with no overlays or any additional restrictions, which is kind of nice. So please ask when you don't know the lender and you don't know where this is coming from, or you're representing the seller, make sure you ask those questions. Now, qualifying income, qualifying income is a pretty big deal. We end up with a VA, it's a little tricky. There's a couple tricky pieces that we have to include in here that we don't have to include with conventional or FHA loans. All of the stuff that you see in here is included. There's 2 items in here that I'm going to point out that we have to include that is not required with a conventional or FHA. And that is family support, and that's also the child care expenses. Now, child support, if you're required to do, if you're required to pay child support, then that's going to be included for everybody. But the child care expenses is the piece that gets missed an awful lot when loan officers are doing the calculations for these buyers. I've had people with child care expenses in the tune of $900 to $1,400 a month. That's like an extra credit card payment for the VA loan people. Now that to me is a little highly unfair because conventional and FHA does not require that piece, but in this case, they're required. And so we have to look at that stuff very carefully. And the reason why is there's one extra calculation that we have to do for the veteran, which is called residual income. Residual income is after all expenses, how much money are they getting to keep on a weekly basis? And the reason is the reason why they include child care expenses in here is because a veteran may get deployed and they may have to have child care, on a routine basis. That child care can disqualify people from buying a house.
What if like your mom watches your kid or something?
Then that's all I have to say. Okay. That's all I have to say. But if you have child care expenses, to the tune of $1,400, then now you're in, that's a $1,400 a month credit card payment. That's how they look at it. And so we have to do residual income calculations after all this is over, just to make sure that that veteran has the ability to feed the family, keep the lights on, go to work, stuff like that.
What is family support? What does that mean?
Family support, like if they're supporting family in Cuba.
Oh, okay.
Like they're sending, gift cards or stuff like that. Military allowances, we can use this. Basic housing allowance is something we include. Basic allowance for subsistence, that's another one we can use as far as income. They're not taxable. However, we do have to do compensating factors for that. And we have to use the taxable income anyway. So yeah, all those are items that we have to go through. Additional qualifying information. Now, the VA is slightly different than conventional and FHA when it comes to this interested party contributions. So what is an interested party contribution? What does that mean? Who would be an interested party in a transaction in real estate? Okay, so I'm the people on the mortgage, so I'm the mortgager, so I'm an interested party because I'm getting paid by their activity, right? The agent, the real estate agent would be an interested party. So who else would be an interested party?
People?
The seller, right?
Yeah.
The seller would be an interested party in this as well. So what that means is that the interested parties can only contribute up to a certain amount of money towards the buyer's closing costs in order for them to be able to qualify for this home. Now, the VA is different. With FHA, it's 6%. With conventional, it's a sliding scale between 3 and 6%. With VA, it is a flat 4%. Now, this flat 4% is pretty cool the way the VA has it structured. Because if they get the full 4%, and let's say that's on a $400,000 home, okay, that's $16,000. Well, you're not going to need $16,000 to close on that house. You probably need, let's call it 9. So you're going to have $7,000 left over. Every other loan, it's a use it or lose it. With the VA, it is not like that. With the VA, you can take that $7,000 that's left and you can pay off a credit card. You can pay down a car. You can pay down other student debt. You can pay off other items like that. The VA is the only one that allows it. And that is a tremendous benefit to the VA. Okay. And so if you have a veteran out there that is looking to do something and they get seller concessions above and beyond, they can use that to pay off. I had one person who had to have 3 credit cards paid off. And they were like $6,000 in credit cards.
How does that work though, in terms of like how they get the payment? Is the payment made directly to their card company? They have to approve that, or do you just give them the cash and they use it to do what they want?
Great question. So when we're dealing with a situation where they have to pay it off to close, then the title company handles that for us.
Okay.
But if it's a situation where they don't have to pay it off to
It's not
close,
necessary, yeah.
they make the check out to the creditor, but they give it to the veteran to mail in.
Mhm.
Okay. All right. Cash reserves, they're not required with the VA, which is actually pretty cool. The AUS system DU or LP is going to tell us which ones or which way we need to go with that. The gifts, they can, this is a great thing about VA too, is they can receive a gift for everything.
Oh, wow.
They can receive a gift for all the closing costs, for everything associated with that. Now, it's a typical donor letter. We do have to go through anti-money laundering laws. And so with the anti-money laundering laws, we have to prove that they are not laundering money to get this. And as long as we can prove that they're not laundering money, then that's perfectly fine. Now, here's what that means when we say not laundering money. The donor has to provide a bank statement showing that they had the money to give. And that's just the way it works. So if we have any black helicopter people that don't necessarily want to provide that bank statement, they can't, because they can't block anything off. They can't run a Sharpie over the numbers. They can't do any of that stuff. It literally is, they have to give us a 30-day bank statement showing that they had the money to give. If they're not willing to give that bank statement, they cannot donate the money. They cannot gift it.
What's the day limit on gifting? What did you say before? In other words, how long does that have to be in my account before it's not considered a gift?
30 days.
30 days. Okay.
Right. No, well, for the buyer, it's 60. For the donor, it's 30.
Okay, but I'm saying, so if I get it 2 months ahead.
If you get 2 months ahead, that's great. But nobody seems to plan that far ahead.
Yeah.
One day's market, I guess.
I mean, long-term planning for some people is lunch, you know, so. It's like, so. All right, so next page here. Additional qualifying information. You can't have non-occupant co-borrowers. Now, the big deal also with eligibility is this. Okay, non-occupant co-borrowers, you can't do. But number 2, this is a big trip up for a lot of people, especially in today's day and age. They do not allow non-married co-borrowers. So they have to be married. And so I've had people who want to get on the loan together. I had the couple I was dealing with this morning, they're getting married in November, but they want to buy the home in September. Well, guess what? They're not buying it with a VA. It's either that or they need to go down to the justice of peace and just tie them out ahead of time and then do the official ceremony later. You You know, so those
Yeah.
are opportunities
Go
that
down
they
the
can
courthouse,
do.
Get it done.
Yeah, get it over with. If you know this is the right person, just do it.
Do it.
Okay.
Do it anyway.
Yeah, do it.
I haven't kept up with is gay marriage across the whole nation now, or is it, I mean, is
I
that
don't know that
legal?
answer.
I'm just wondering, like, can two gay people that,
They got the same last
If they have a
name.
marriage certificate, I
Marriage
think that the
certificate,
answer is yes.
okay, because I know like a girl I used to work with, her and her wife went to DC because it was legal there before it was legal here, so I didn't know. But I
Yeah.
guess it doesn't matter as long as you have.
I think if you have a marriage certificate, the VA is pretty open to that, but I don't know all the semantics of that piece
Mhm.
because I haven't done one like that yet.
Gotcha.
Okay. But I will check into that because that's an interesting question. Borrower funds. So we have to come from acceptable sources. Now, this is an acceptable source going back to anti-money laundering is a fairly big deal. An acceptable source means that we have to prove that the money was truly yours and that you're not laundering money. So we have to go back 60 days in your bank statements. We have to go back and look at other things like that just to make sure that you're not laundering money. Now, the assumption is never that you're laundering money, but unfortunately, we have to go through that assumption because there are some people that are. That is actually one of the favorite ways of laundering money to make money legal, is for them to go out and buy a home with cash or insert or inject cash into housing and to be able to, you know, then make it legit by turning around and flipping the house. So this is a pretty big deal when they do this. And quite frankly, we don't look at every single penny that's deposited, but if it looks suspicious, so if it looks like a duck, it quacks like a duck, the water runs off its back like a duck, there's a very good chance we have a duck. And so they're going to be asking questions, and the more it starts quacking like a duck, the more the questions they're going to be asking. Now, with the VA, there's no way to get around the 30-day timeline for donors, and there's no way to get around the 60-day timeline because of how we look at it. So sometimes we may have to structure loans based off of, and I've had to do this before, where we've had to structure loans based off of when they deposited the cash. And so I've dealt with people who have shown up with suitcases of cash. Luckily, I don't get that very often, but they deposit it into their account thinking, well, I just sold my boat. I have the $10,000 at home. I'm just going to go ahead and put it in there, but there's no bill of sale. There's nothing there to prove that they actually had this money to start with, or had this, that owned this property to start with. And so now we have to go through the process of either showing that they own that, or we have to find a way to get that 60-day cycle to work so that we don't have to pay attention to that. And so what that may mean is sometimes we have to do a transaction history. So they deposited on the 28th. We get a transaction history starting on the 29th when it finally clears. And that transaction history goes up to the next bank statement, which starts on the 17th of the following month. And then we get that full bank statement, and then we get the rest as a transaction summary. So it's not that you have to have 2 full cycles, but you do have to show 60 days. Okay. All right, so there's that. Significant credit events. The VA is actually more friendly to credit events than anything else out there. And so you need to be very, very cognizant of that. With bankruptcy, foreclosures, and other things like that, they actually have a very, very lenient set of guidelines on this compared to some of the other ones. So from a short sales are looked at as foreclosures in our world for the most part. With a VA, you can get by with a 2-year, whereas most other places, it's much longer than that. Okay. Bankruptcies, it's 2-year waiting period unless it's a Chapter 13. Chapter 13, I want to point this out. You can do it while you're in the middle of a bankruptcy, but I do need to point out that that is a very, 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 very difficult transaction to complete if you're trying to buy a home while you're in the middle of bankruptcy. Because number one, the VA does not fund anything, the investor does. And so we have to find an investor who's willing to take it. Number two, we have to get the trustee of the court to prove and to give us a letter stating that you're okay adding this debt even though you're in bankruptcy. And then number three, you've got to get a seller to agree to hold on to this because the trustee wants a ratified contract. And it takes 90 days for the trustee from the time that they get it to accept it. Okay, well,
On this market.
in this market, that's a tough thing to do, unless you're finding a home that has been sitting on the market for like 6.5 years. Okay,
Now,
okay, so you kind of get where I'm headed with this whole thing with a chapter 13. So when I'm dealing with people with chapter 13 that are like, yeah, I can do it, theoretically, you are correct. You can do it. Practically is different than theoretically.
Yeah.
And so let's talk about what that means to you, because many times that may mean that in your best interest, you need to rent at least 1 more year, or you need to rent until you're discharged. And then because we have to not only do that, but remember, we got to run it through AUS to make sure that this happens. And every time we run it through AUS, when you're in the middle of bankruptcy, we have to do a manual underwrite. And a manual underwrite is really difficult to get done. All right, so properties and appraisals. So with the appraisal, what you need to know with this is the appraisals are great to have. You have to have them with a VA. You cannot waive the appraisal with a VA. I know in this market, everybody wants to try to waive some of those things. You can't waive the appraisal. Now, that doesn't mean that you can't agree to pay above and beyond the appraisal, but you cannot force the veteran to waive it. In fact, you will be signing an amendatory clause stating that you will not force them to pay the difference between the appraised value and what they're trying to buy it for. There's an amendatory clause and you cannot get around it. You have to sign it. So regardless of whatever addendum you put in there, that amendatory clause is coming. And they're not going to complete this transaction without doing this. So if you run into a VA who wants to do this, now this is one of the pieces where a lot of people in the market right now don't want to use a VA because of that. But it still comes down to a gentleman's agreement. Either you're going to buy it or you're not, whether it's overpriced or underpriced or wherever it is in the process. Okay.
They can agree to pay it, you just can't force them to pay
You
it.
can't force to pay it.
But they can agree.
They can agree to pay it. Okay. They have to send a notice of value out to the buyer, and it's valid for 6 months. What that also means is that when we pull the case number for the VA, that property, that appraiser is going to be looking at the value, and that that value sticks with the house. It stays with the house for a period of time, 120 to 180 days. Okay, big deal right there. So the downside to the appraisal, whereas I can rush an appraisal with FHA and conventional, I have zero control over the appraisal when it comes to a VA. I actually have to contact the VA. The VA has to assign me an appraiser, and I literally can't talk to the appraiser, push the appraiser, rush the appraiser, do anything to the appraiser until day 16. Now, if on day 16, they have not completed the appraisal, now I can yell it, now I can scream, now I can push, now I can do all sorts of things. But until day 16, I can't do a blasted thing with these people. Okay.
So we write the contract, the buyer's agreement, where it says, we'll get the appraisal done within so-and-so timeframe. We need to put how many days there?
that's for the
14.
inspection that you write in.
Oh, okay.
Yeah.
Okay.
You
Yeah.
don't put a date for the appraisal.
For the
Okay.
appraisal, you just kind of tell them that you're going to order it right away, because there's no way of, with the VA, you're not going to be able to tell.
And you just stay in communication with them about,
All right, so the appraiser also does what is called a head and shoulders inspection. And with a head and shoulders inspection, what they're going to be doing is they're going to be poking their head inside the walls of every door, not the walls, inside the door frame, I'm sorry, of every wall, of every room. And also they're poke their head into the attic, up to their shoulders, into the crawl space, up to their shoulders. And they're going to be looking for obvious problems with the house. Now, obvious problems with the house are slightly different, and this is where the consumer and a lot of the agents have gotten jaded against the VA loan, I think unrightfully so. Especially in this market where you can sell a shack and get full price and then some for it. Right, with a VA, they're going to say there are certain deficiencies that are going to inhibit the value, and they're going to inhibit the livability of this home. We want those things fixed. Now, what that means is if you were to walk into the room yourself and say, oh my goodness, what just happened there? That's what the appraiser is going to note. If there's a hole in the wall, if there's broken windows, broken doors, broken siding, holes in the roof, that's the kind of stuff that the VA is going to be looking at. Okay. Also, one other thing that they look at is if it's there, they're going to be expecting it to work. So if they have a trash compactor in there from the 1960s, it needs to work. Okay, it doesn't necessarily have to be beautiful. It doesn't have to be anything but avocado green. Okay, but it has to work. Now, if they don't have a trash compactor in there, or they don't have a dishwasher in there, that's fine. Okay, but if it's there, it has to work.
Chris, what about something?
Go ahead
like an
and do that.
empty
Now,
oil?
if they find one of the biggest issues that seems to be a problem with the VA and also with FHA is flaking paint. So if they have bare wood or raw wood that has not been primed or painted, or the paint is flaking off of that, they're going to have to scrape it and get it to a bare minimum that it's no longer bare wood. Now, these days the seller's not doing a whole lot. And so you have to decide how you're going to handle that piece. Most people right now with a VA loan, what they're saying is that we're just not fixing anything. And if that's the case, now you're in a little bit of trouble, because the VA is going to require those items to be fixed prior to settlement. Okay, now that doesn't mean that the seller has to fix them. The borrower can go in and fix them, but there's risk with the borrower doing this. When I bought my first home, I bought an abandoned home. I didn't have any windows. I didn't have any doors. There was graffiti on the living room wall and on the floors. Now they were tile floors. I had to go in before closing and put windows and doors in. Nobody told me that if that didn't close, I just invested a ton of money in this abandoned home, and I invested it to the person who was the owner of this home. Okay. Now, luckily for me, the home closed. But I've had other people who didn't tell me that they were going to do this. I had one person literally this spring go out and put an offer in on a home. And they put an offer in a home, and one of the bathrooms was at studs. In other words, it's not finished. And they went in, they agreed in a handshake. They didn't do anything in writing. They agreed in a handshake that the buyer would go in and finish this thing off so that they could get it done. The problem is that after they got done doing this, the buyer and the seller got into a spat. And they ended up having to release. And this person put $4,000 to $5,000 into this bathroom,
Wow.
and they lost it all. So it doesn't mean that you can't do this, but you need to be smart about how you're doing this. You need to do it, number one, after you're done with underwriting, and you probably need to have an addendum of some sort, making sure that the seller reimburses you if this thing doesn't close. Okay, now that's kind of, now those are, obviously you want the seller to do it. But if it comes to push to shove, now you kind of know what you're dealing with. Okay. All right. Woo, look at that. We are 5 minutes early. All right. Any thoughts, any questions? Anybody online with some questions?
Chris, I wanted to know.
Anybody, either I did a great job or everybody fell asleep.
Can you hear me?
Right. All right. So I'm going to go ahead and stop recording. And if I know how to do that, we're going to stop recording.